Question 1. Strategic planning requires an insurance executive to evaluate a potential acquisition of a competitor. The executive learns through a personal contact that the target company's CEO is willing to offer the executive a significant personal stake in a separate, unrelated venture if the acquisition proceeds successfully. The executive has not disclosed this offer to the board. What is the most appropriate course of action for the executive? Option A. Immediately disclose the personal offer to the board of directors and recuse themselves from all discussions and decisions regarding the acquisition. Option B. Accept the personal offer from the target company's CEO and then disclose it to the board, arguing it demonstrates strong personal commitment to the deal's success. Option C. Proceed with the acquisition recommendation, believing the strategic benefits to the company outweigh the personal offer, and consider the personal offer later. Option D. Discreetly inform the target company's CEO that the personal offer is not a factor in their professional recommendation, but continue to lead the acquisition evaluation. Correct answer is A. Immediately disclose the personal offer to the board of directors and recuse themselves from all discussions and decisions regarding the acquisition. Explanation. This scenario presents a professional challenge because it pits the executive's fiduciary duty to the company and its shareholders against a potential personal gain that could compromise their objectivity and the integrity of the strategic decision-making process. The executive's role demands a commitment to acting in the best interests of the company, which includes ensuring that strategic decisions are based on sound business rationale and not influenced by personal incentives. The insurance executive certificate, particularly within a UK regulatory context, emphasizes principles of integrity, objectivity, and due diligence. The correct approach involves transparently disclosing the potential conflict of interest to the board of directors and recusing oneself from any decision-making processes related to the acquisition. This aligns with the UK Corporate Governance Code's emphasis on board independence and the Financial Conduct Authority's (FCA) principles for business, which require firms to act with integrity and due skill, care, and diligence. Disclosure ensures that the board can make an informed decision, free from undue influence, and upholds the executive's duty of loyalty to the company. It also safeguards against potential breaches of insider trading regulations if the information were to be used improperly. An incorrect approach would be to proceed with the acquisition recommendation without disclosing the personal interest. This constitutes a failure of integrity and objectivity, violating the executive's fiduciary duties. It could also lead to a breach of the FCA's principles for businesses, specifically Principle 1, integrity, and Principle 2, skill, care, and diligence, as the decision-making process would be tainted by a personal motive. Furthermore, failing to disclose could be construed as an attempt to mislead the board and shareholders, potentially leading to reputational damage and legal repercussions. Another incorrect approach would be to attempt to negotiate a personal benefit from the target company after the acquisition is complete, without prior disclosure. This is ethically problematic as it still represents a conflict of interest and could be seen as an attempt to profit personally from a decision made under a compromised position. It also risks violating regulations concerning personal account dealing and conflicts of interest if not properly managed and disclosed. A professional decision-making process in such situations should involve a clear understanding of one's fiduciary duties and the relevant regulatory framework. When a potential conflict of interest arises, the immediate step should be to identify it, assess its materiality, and then follow established company policies and regulatory guidelines for disclosure and recusal. Seeking advice from the company's legal or compliance department is also a crucial step to ensure all obligations are met. Question 2. Compliance review shows that the underwriting department is considering implementing new guidelines for assessing mortality and morbidity risk. One proposed approach involves categorizing applicants based on broad lifestyle indicators and demographic data to predict future health outcomes. Another suggestion is to prioritize speed of underwriting and market competitiveness, potentially by streamlining the assessment of certain pre-existing conditions. A third option is to leverage advanced predictive analytics and artificial intelligence to automate risk assessment, which approach best aligns with the principles of sound underwriting and regulatory compliance in assessing mortality and morbidity risk. Option A. Implementing underwriting guidelines that categorize applicants based on broad lifestyle indicators and demographic data to predict future health outcomes, even if these categories are statistically derived. Option B. Developing underwriting criteria based on objective, actuarially supported data that assesses individual health status and lifestyle factors demonstrably linked to mortality and morbidity risk, while ensuring these factors are applied consistently and without unfair discrimination. Option C. Prioritizing speed of underwriting and market competitiveness by streamlining the assessment of certain pre-existing conditions, potentially accepting higher levels of risk to expedite policy issuance. Option D. Relying solely on automated underwriting systems that utilize predictive analytics and artificial intelligence to assess risk, without a robust human oversight or validation process for the algorithms. The correct answer is B. Developing underwriting criteria based on objective, actuarially supported data that assesses individual health status and lifestyle factors demonstrably linked to mortality and morbidity risk, while ensuring these factors are applied consistently and without unfair discrimination. Explanation. This scenario presents a professional challenge because it requires an executive to balance the need for accurate risk assessment in underwriting with the ethical imperative to avoid discriminatory practices. The core difficulty lies in distinguishing between legitimate underwriting factors related to mortality and morbidity risk, and those that could be construed as unfair discrimination based on protected characteristics. Careful judgment is required to ensure that underwriting practices are both compliant with regulatory frameworks and ethically sound. The correct approach involves a nuanced understanding of how specific health conditions and lifestyle factors demonstrably impact mortality and morbidity risk, without relying on broad generalizations or assumptions tied to protected groups. This approach prioritizes objective, actuarially sound data to assess individual risk. It aligns with the regulatory framework by focusing on the inherent risk of the individual applicant rather than their membership in a particular group, thereby preventing unfair discrimination. Ethically, it upholds the principle of treating individuals based on their unique circumstances and risk profile. An incorrect approach that relies on broad demographic assumptions about health outcomes, even if seemingly supported by general statistical trends, fails to meet the regulatory requirement of individual risk assessment. This can lead to unfair discrimination if these assumptions are applied rigidly, without considering individual variations. Such an approach risks violating regulations that prohibit discrimination based on factors not directly and demonstrably related to the risk being underwritten. Another incorrect approach that prioritizes market share or competitive pricing over accurate risk assessment is ethically and regulatorily unsound. While business objectives are important, they cannot supersede the fundamental principles of sound underwriting and fair treatment of customers. Ignoring or downplaying significant mortality or morbidity risks for commercial gain exposes the insurer to financial instability and can lead to mispricing of products, ultimately harming policyholders. A third incorrect approach that delegates underwriting decisions entirely to automated systems without human oversight or validation is also problematic. While technology can enhance efficiency, it must be programmed with ethically sound and regulatorily compliant logic. Over-reliance on algorithms without understanding their underlying assumptions or potential biases can perpetuate or even amplify discriminatory practices, even if unintentionally. The professional decision-making process for similar situations should involve a thorough review of the underwriting guidelines against current regulatory requirements and ethical best practices. This includes consulting actuarial data to ensure that underwriting factors are scientifically supported and individually applicable. Executives must foster a culture where underwriting teams are trained to identify and mitigate potential biases, and where there is a clear process for challenging or refining underwriting criteria based on new evidence or regulatory guidance. A commitment to transparency and fairness in all underwriting decisions is paramount. Question 3. Compliance review shows that a significant number of policies are being issued with minor discrepancies between the underwriting approval, the customer's application details, and the final policy wording. The operations team is proposing to issue policies based on the underwriting approval and then send out endorsements to correct any identified discrepancies within 48 hours, citing efficiency gains and meeting service level agreements for policy issuance speed. As an executive, what is the most appropriate course of action to ensure compliance and protect policyholder interests? Option A. Implement a strict pre-issuance verification process where all policy documents are cross-referenced against the underwriting approval and application details, and any discrepancies, however minor, must be resolved before the policy is issued. Option B. Issue policies based on underwriting approval and include a disclaimer in the policy document stating that endorsements will follow to correct any discrepancies, ensuring the customer is aware of potential changes. Option C. Delay policy issuance until all discrepancies are fully resolved, even if it means significantly exceeding service level agreements for policy issuance, to guarantee absolute accuracy from inception. Option D. Authorize the operations team to issue policies based on underwriting approval and immediately send out endorsements to correct any discrepancies within 48 hours, as this improves efficiency and meets SLAs. The correct answer is A. Implement a strict pre-issuance verification process where all policy documents are cross-referenced against the underwriting approval and application details, and any discrepancies, however minor, must be resolved before the policy is issued. Explanation. This scenario presents a professional challenge because it requires an executive to balance the operational efficiency of policy issuance with the stringent regulatory requirements for accuracy and customer protection. The pressure to meet service level agreements, SLAs, for policy issuance can create a temptation to bypass or expedite checks, which could lead to significant compliance breaches and harm to policyholders. Careful judgment is required to ensure that speed does not compromise the integrity of the policy contract and the insurer's regulatory obligations. The correct approach involves a thorough review of the policy wording against the underwriting decision and the customer's application details before issuance. This ensures that the policy accurately reflects the agreed terms, conditions, and coverage, and that all regulatory disclosures have been made. This approach is justified by the regulatory framework's emphasis on contract certainty and consumer protection. Specifically, regulations typically mandate that policy documents must be clear, accurate, and free from misleading information. Issuing a policy that does not precisely match the underwriting approval or application details constitutes a breach of contract and potentially a breach of conduct rules requiring fair treatment of customers. It also undermines the insurer's ability to manage its risk profile accurately. An incorrect approach of issuing the policy immediately based on the underwriting approval, assuming the administrative team will correct any minor discrepancies later, is professionally unacceptable. This fails to uphold the principle of contract certainty. The policy document is the legal contract, and any discrepancies, even if intended to be corrected post-issuance, mean the policyholder is not initially covered as agreed or understood. This can lead to disputes, claims being denied incorrectly, and reputational damage. It also violates the duty to provide accurate information to consumers. Another incorrect approach of delaying issuance until a perfect match is achieved, even for trivial discrepancies, is also professionally suboptimal. While it prioritizes accuracy, it can lead to significant delays that breach SLAs, potentially causing financial harm to the customer who needs coverage urgently. This approach fails to demonstrate efficient administration and may not align with regulatory expectations for reasonable processing times, provided that accuracy is not compromised. The challenge lies in finding the balance between speed and accuracy, and this approach leans too heavily on the latter at the expense of operational efficiency and customer service. A third incorrect approach of issuing the policy with a note to the customer that discrepancies will be addressed in a subsequent endorsement, without first confirming the underwriting approval and application details, is also flawed. This is similar to the first incorrect approach in that it issues a potentially inaccurate contract. While it attempts transparency, it still exposes the policyholder to uncertainty regarding their immediate coverage and may not satisfy regulatory requirements for a clear and accurate initial policy document. The onus is on the insurer to issue the correct policy from inception. The professional decision-making process for similar situations should involve a risk-based assessment. Executives must understand the potential impact of any discrepancy on the policyholder, the insurer's financial stability, and regulatory compliance. They should establish clear internal procedures that define acceptable levels of discrepancy and the escalation process for significant issues. When faced with a discrepancy, the immediate priority should be to verify the accuracy of the policy document against the underwriting decision and the customer's application. If minor, correctable errors are identified, The process should allow for immediate correction before issuance. For more significant issues, the policy should not be issued until the discrepancy is resolved and the policy accurately reflects the agreed terms. This ensures both regulatory compliance and customer trust. Question 4. Quality control measures reveal that the cash flow statement for an insurance company under the Insurance Executive Certificate Regulatory Framework appears to present a strong operating cash flow. However, upon closer inspection, a significant portion of cash received from the early termination of certain annuity contracts, which are core to the insurer's product offerings, has been classified under financing activities rather than operating activities. Which of the following approaches best evaluates this situation to ensure regulatory compliance and accurate financial reporting? Option A. Reclassify the cash flows from annuity contract terminations from financing activities to operating activities, as these represent cash generated from the insurer's core business operations. Option B. Recommend a review of the company's investment portfolio to identify potential misclassified cash flows that could bolster operating cash flow. Option C. Accept the classification as presented, assuming management has made appropriate judgments based on their understanding of the business. Option D. Focus on the overall net change in cash and cash equivalents, as the specific classification of individual items is less critical for executive-level oversight. The correct answer is C. Accept the classification as presented, assuming management has made appropriate judgments based on their understanding of the business. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an executive to interpret and apply the principles of cash flow reporting within the specific regulatory framework governing insurance companies. The challenge lies in distinguishing between legitimate operational cash flows and those that might be misclassified or presented in a way that obscures the true financial health of the insurer, potentially misleading stakeholders. Accurate cash flow reporting is critical for solvency, liquidity management, and investor confidence, all of which are heavily regulated in the insurance sector. Correct approach analysis. The correct approach involves a thorough review of the cash flow statement, focusing on the classification of cash flows into operating, investing, and financing activities, and ensuring that these classifications align with the specific accounting standards and regulatory guidance applicable to insurance entities. This includes verifying that cash generated from core insurance operations, premiums received, claims paid, policyholder benefits, is correctly categorized as operating cash flow. Investing activities should reflect the insurer's portfolio management, purchases and sales of investments, and financing activities should represent debt and equity transactions. The emphasis is on transparency and adherence to the prescribed reporting structure to provide a true and fair view of the company's cash generation and usage, which is a fundamental requirement of regulatory compliance and sound financial stewardship. Incorrect approach is analysis, an approach that prioritizes presenting a favorable cash flow picture by reclassifying significant outflows from operating activities to investing activities, such as the purchase of short-term investment securities intended to meet immediate liquidity needs, is incorrect. This misrepresentation distorts the operational performance and liquidity position, violating the principle of true and fair presentation mandated by regulatory bodies. It masks the true cost of running the insurance business and can lead to an overestimation of operating cash flow. Another incorrect approach would be to exclude certain significant cash inflows related to policy surrenders or maturities from operating activities, and instead present them as financing inflows. This failure to accurately reflect cash flows arising from the core insurance contracts undermines the integrity of the operating cash flow section, which is designed to show the cash generated from the primary business of insurance. Such a misclassification can mislead analysts and regulators about the insurer's ability to generate cash from its core business. Finally, an approach that focuses solely on the net change in cash without scrutinizing the underlying classifications and the nature of the transactions is insufficient and potentially misleading. While the net change is a summary figure, the regulatory requirement is for detailed and accurate reporting of the components of cash flow, allowing for an understanding of the sources and uses of cash. Omitting this detailed analysis risks overlooking misclassifications or non-compliant reporting practices. Professional reasoning. Professionals in this role must adopt a critical and analytical mindset when reviewing financial statements, particularly the cash flow statement. The decision-making process should begin with a clear understanding of the relevant regulatory framework and accounting standards. This involves identifying the specific rules for classifying cash flows within the insurance industry. When presented with a cash flow statement, the executive should systematically assess each section, operating, investing, financing, against these established guidelines. Any transaction that appears unusual or is classified in a way that seems to obscure the underlying economic reality should be investigated further. The professional should ask, does this classification accurately reflect the economic substance of the transaction and comply with regulatory requirements? If there is doubt, seeking clarification from accounting experts or internal audit and cross-referencing with other financial statements and disclosures is essential. The ultimate goal is to ensure that the financial reporting is not only compliant, but also provides a transparent and accurate representation of the company's financial position and performance. Question 5. The risk matrix shows that a technology consulting firm faces a high probability of client disputes arising from the performance and advice provided by its consultants, and a high impact from potential financial losses incurred by clients due to these disputes. The firm also has a moderate probability of data breaches impacting client information. Given these identified risks, which of the following insurance coverage strategies best aligns with prudent risk management for this firm? Option A. Rely on the firm's existing general liability policy, as it is designed to cover all business-related liabilities. Option B. Invest primarily in cyber liability insurance, as data breaches are the most significant technological risk. Option C. Prioritize securing comprehensive professional liability insurance to cover claims related to errors, omissions, and negligence in the provision of consulting services, and supplement this with adequate cyber liability insurance. Option D. Focus solely on obtaining the broadest possible general liability insurance policy, assuming it will cover most operational risks. Correct answer is C. Prioritize securing comprehensive professional liability insurance to cover claims related to errors, omissions, and negligence in the provision of consulting services, and supplement this with adequate cyber liability insurance. Explanation. This scenario presents a professional challenge because it requires an executive to interpret complex risk assessments and translate them into appropriate insurance coverage strategies, balancing the company's financial health with its legal and ethical obligations. The executive must demonstrate a nuanced understanding of different liability types and their applicability to specific business operations, ensuring that inadequate coverage does not expose the company to significant financial or reputational damage. The challenge lies in accurately identifying the most pertinent risks and selecting coverage that directly addresses them, rather than adopting a one-size-fits-all approach. The correct approach involves a thorough review of the risk matrix, identifying the highest probability and highest impact risks, and then matching these to the most suitable coverage types. Specifically, for technology consulting firm, professional liability, also known as errors and omissions or E&O, is paramount due to the inherent risk of providing advice, services, or designs that could lead to financial loss for clients. General liability, while important for physical premises and operations, does not typically cover the professional advice rendered. Cyber liability is also crucial given the nature of technology services, addressing data breaches and system failures. The executive's responsibility is to ensure that the chosen insurance policies comprehensively address these identified risks, aligning with regulatory expectations for prudent risk management and the duty of care owed to clients. This aligns with the principles of good corporate governance and the need for adequate risk mitigation as expected under the Insurance Executive Certificate Framework, which emphasizes understanding and managing insurance products effectively. An incorrect approach would be to solely focus on general liability insurance. This fails to acknowledge the specific professional risks associated with a technology consulting firm. Regulatory frameworks and professional standards expect businesses to insure against the unique risks they face. Relying only on general liability would leave the firm exposed to claims arising from faulty advice, design errors, or negligence in service delivery, which are core to professional liability claims. This oversight constitutes a failure in due diligence and risk assessment, potentially violating industry best practices and client service agreements. Another incorrect approach would be to prioritize cyber liability to the exclusion of professional liability. While cyber risks are significant for a technology firm, neglecting professional liability would be a critical error. Claims related to the quality of advice or the failure of a delivered solution to meet specifications are distinct from cyber incidents. A comprehensive insurance program must address both, reflecting a holistic understanding of the firm's risk profile. This selective focus demonstrates a lack of understanding of the distinct coverage provided by different liability policies and a failure to adequately protect the firm against a broad spectrum of potential claims. A third incorrect approach would be to assume that existing general liability coverage automatically extends to professional errors. This is a fundamental misunderstanding of insurance policy definitions. General liability typically covers bodily injury and property damage arising from business operations, not the economic losses resulting from professional services. Failing to secure specific professional liability coverage would leave the firm uninsured for a significant category of claims, representing a serious lapse in risk management and potentially exposing the firm to substantial financial liabilities that could jeopardize its solvency. The professional decision-making process for similar situations should involve a structured risk assessment, followed by a detailed review of available insurance products. Executives must consult with risk management professionals and insurance brokers to gain a comprehensive understanding of their firm's specific exposures. They should then evaluate insurance proposals against these identified risks, ensuring that coverage is adequate, appropriate, and compliant with any relevant industry regulations or contractual obligations. This systematic approach ensures that insurance serves its intended purpose of mitigating financial impact from unforeseen events. Question 6. Governance review demonstrates that the company has a comprehensive, formally documented governance manual. As a newly appointed executive, which approach best reflects a proactive and compliant assessment of the company's governance framework? Option A. Review the most recent marketing materials to understand the company's outward-facing communication strategies and ensure they align with the documented governance manual. Option B. Conduct a thorough assessment of how the documented governance policies are practically implemented across all departments, evaluating the effectiveness of internal controls and the clarity of roles and responsibilities in relation to regulatory expectations. Option C. Focus on the profitability of the last 2 product launches, as this indicates successful execution of business strategy, which is a key outcome of effective governance. Option D. Examine the existence and completeness of the formal governance manual, assuming that its documentation implies effective implementation and adherence. The correct answer is B. Conduct a thorough assessment of how the documented governance policies are practically implemented across all departments, evaluating the effectiveness of internal controls and the clarity of roles and responsibilities in relation to regulatory expectations. Explanation. Scenario analysis. This scenario presents a common challenge in the insurance industry where a newly appointed executive must quickly assess and understand the existing governance framework. The challenge lies in discerning between superficial compliance and genuine, effective governance that aligns with regulatory expectations and promotes sound business practices. The executive needs to move beyond simply identifying policies to evaluating their practical implementation and their impact on risk management, ethical conduct, and stakeholder protection. This requires a critical and analytical mindset, not just a descriptive one. Correct approach analysis. The correct approach involves a comprehensive evaluation of the existing governance framework against established regulatory principles and best practices relevant to the insurance executive certificate jurisdiction. This means not only reviewing documented policies and procedures, but also assessing their practical application, the effectiveness of internal controls, the clarity of roles and responsibilities, and the overall ethical culture. It requires understanding how governance mechanisms translate into tangible outcomes, such as robust risk management, fair treatment of customers, and financial stability. Regulatory justification stems from the fundamental duty of executives to ensure the firm operates within the legal and ethical boundaries set by the relevant supervisory authorities, promoting the integrity and stability of the insurance market. Incorrect approach is analysis. Focusing solely on the existence of a formal governance manual without assessing its implementation or effectiveness represents a superficial understanding. This approach fails to address whether the documented policies are actually followed or if they adequately mitigate risks. It is a compliance-focused, rather than a substance-focused, evaluation. Prioritizing the review of recent marketing materials over governance structures demonstrates a misaligned focus. While marketing is important, it is secondary to the foundational governance that underpins the entire operation. This approach neglects the core responsibilities of an executive in ensuring the firm's operational integrity and compliance. Concentrating exclusively on the profitability of recent product launches without considering the governance that enabled these launches is also a flawed approach. Profitability is an outcome, but it does not inherently indicate sound governance. A profitable launch could have been achieved through practices that, while generating revenue, might have exposed the firm to undue risk or ethical compromises, which would be a significant regulatory failure. Professional reasoning. Professionals in executive roles must adopt a holistic and critical approach to governance review. The process should begin with understanding the regulatory landscape and the specific expectations for insurance executives. This involves identifying key governance components, such as board oversight, risk management frameworks, internal controls, compliance functions, and ethical conduct policies. The next step is to assess the practical implementation of these components, looking for evidence of effectiveness through internal audits, risk assessments, and discussions with relevant personnel. Professionals should then evaluate how these governance elements contribute to the firm's overall objectives, ensuring they align with regulatory requirements and ethical standards. A key decision-making tool is the ability to connect documented policies to observable behaviors and outcomes, thereby identifying potential gaps or weaknesses that require remediation. Question 7. The control framework reveals a pattern of extended claims investigation times and a potential for inconsistent application of policy terms during the assessment phase. As an executive responsible for claims oversight, what is the most appropriate initial course of action to address these findings? Option A. Implement immediate disciplinary measures for claims handlers whose files exhibit the longest investigation times to serve as a deterrent. Option B. Initiate a comprehensive review of the claims investigation and assessment procedures, including staff training needs and process bottlenecks, to identify root causes and develop targeted improvements. Option C. Immediately engage an external claims management firm to take over all investigation and assessment functions without an internal diagnostic. Option D. Classify the findings as minor operational variances and focus resources on other strategic initiatives, assuming the issues will resolve themselves over time. The correct answer is B. Initiate a comprehensive review of the claims investigation and assessment procedures, including staff training needs and process bottlenecks, to identify root causes and develop targeted improvements. Explanation. This scenario presents a professional challenge because it requires an executive to balance the need for efficient claims handling with the regulatory imperative to conduct thorough and fair investigations. The executive must exercise sound judgment to ensure that the company's internal processes do not compromise the integrity of its claims assessments or lead to potential regulatory breaches. The challenge lies in identifying and rectifying systemic weaknesses without causing undue disruption or unfairly penalizing staff. The correct approach involves a systematic review of the investigation process, focusing on identifying root causes of delays and potential biases, and then implementing targeted training and process improvements. This is justified by regulatory requirements that mandate fair and timely claims handling, and the ethical obligation to treat policyholders equitably. A structured investigation into the control framework's findings allows for evidence-based decision-making, ensuring that any remedial actions are proportionate and effective, thereby upholding the company's commitment to regulatory compliance and customer trust. An approach that focuses solely on disciplinary action without understanding the underlying systemic issues is professionally unacceptable. This fails to address the root causes of the control framework's findings and could lead to a cycle of repeated problems. It also risks creating a climate of fear rather than fostering a culture of continuous improvement, potentially leading to staff withholding information or avoiding necessary investigative steps due to fear of reprisal. Another incorrect approach is to dismiss the findings as minor operational inefficiencies without further investigation. This demonstrates a lack of due diligence and a disregard for the potential implications of the control framework's observations. Such an approach could lead to the continuation of flawed practices, increasing the risk of regulatory sanctions, reputational damage, and financial losses due to incorrect claims settlements. It also fails to uphold the executive's responsibility to ensure the company operates within its regulatory obligation. A third incorrect approach is to immediately outsource all claims investigation functions without an internal review. While outsourcing can be a valid strategy, doing so without understanding the internal control weaknesses means the company is not learning from its own experiences and may not effectively select or manage an external provider. This could lead to a loss of internal expertise and potentially higher costs without guaranteed improvement, and it fails to address the fundamental issues within the existing control framework. Professionals should adopt a decision-making framework that prioritizes understanding the problem before implementing solutions. This involves 1. Acknowledging and thoroughly reviewing the findings of the control framework. 2. Conducting a root cause analysis to identify the underlying reasons for any identified weaknesses. 3. Developing a remediation plan that addresses these root causes through process improvements, training, and resource allocation. 4. Monitoring the effectiveness of the implemented changes. This systematic approach ensures that actions are targeted, effective, and compliant with regulatory expectations. Question 8. Risk assessment procedures indicate that a subsidiary insurance company is experiencing significant liquidity challenges due to unexpected claims. The parent insurance group is considering injecting capital into the subsidiary to stabilize its operations. However, the group's own solvency capital ratio is currently at the lower end of its regulatory tolerance band. What is the most prudent course of action for the group executive to ensure compliance with solvency regulations? Option A. Approve the capital injection into the subsidiary immediately to prevent its collapse, assuming the group's overall solvency will recover over time. Option B. Advise the subsidiary to seek external financing or explore a sale of its assets to meet its liquidity needs, thereby avoiding any impact on the parent group's capital. Option C. Proceed with the capital injection based on the subsidiary's management's assurances that the liquidity issues are temporary and will not affect the group's solvency. Option D. Conduct a comprehensive solvency impact assessment of the proposed capital injection on the entire group, considering its effect on consolidated solvency ratios and regulatory capital requirements before approving any funds. The correct answer is A. Approve the capital injection into the subsidiary immediately to prevent its collapse, assuming the group's overall solvency will recover over time. Explanation. This scenario presents a professional challenge because it requires balancing the immediate financial pressures of a subsidiary with the overarching solvency requirements of the parent insurance group. The executive must navigate potential conflicts between short-term profitability and long-term regulatory compliance, which can have significant implications for policyholder protection and market confidence. Careful judgment is required to ensure that any actions taken do not compromise the group's solvency position or violate regulatory principles. The correct approach involves a thorough assessment of the subsidiary's financial health and its impact on the group's consolidated solvency. This includes understanding the specific solvency capital requirements applicable to the group, the nature of the proposed intergroup transaction, and the potential for the transaction to weaken the group's overall capital buffer. The executive must ensure that any capital transfer or support mechanism is structured in a way that demonstrably strengthens, or at least does not impair, the group's solvency position, adhering to the principle of maintaining adequate capital resources to meet all liabilities and policyholder expectations. This aligns with the fundamental objective of solvency regulation, which is to protect policyholders by ensuring insurers can meet their obligations. An incorrect approach would be to approve the capital injection without a comprehensive solvency impact assessment. This fails to acknowledge the interconnectedness of group entities and the regulatory expectation that the parent company is responsible for the overall solvency of the group. Could lead to a situation where the group's capital is depleted to support a struggling subsidiary, potentially jeopardizing the ability of other group entities to meet their obligations. Another incorrect approach would be to prioritize the subsidiary's immediate liquidity needs over the group's solvency requirements without a clear plan for remediation. While supporting a subsidiary is important, it cannot be done at the expense of the group's overall financial stability. This could involve approving a capital injection that, while addressing the subsidiary's short-term issue, creates a solvency deficit at the group level, thereby breaching regulatory thresholds. A third incorrect approach would be to rely solely on the subsidiary's management's assurances without independent verification. Solvency regulation places a responsibility on the group executive to ensure robust oversight and control. Delegating this responsibility entirely to the subsidiary without due diligence would be a failure of governance and a potential breach of regulatory duties. The professional decision-making process for similar situations should involve a structured risk assessment framework. This includes identifying all relevant stakeholders, understanding the regulatory landscape, evaluating the potential financial and operational impacts of any proposed action, and considering the ethical implications. Executives should always err on the side of caution when solvency is concerned, seeking expert advice where necessary and ensuring that all decisions are well documented and justifiable from a regulatory and prudential perspective. Question 9. Process analysis reveals that a significant increase in suspicious transaction alerts has been generated by the company's automated fraud detection system. As the executive director responsible for operational integrity, you must decide on the immediate course of action to manage this situation effectively and compliantly. Which of the following approaches best balances fraud prevention with regulatory and ethical considerations? Option A. Deploy a dedicated team to conduct a rapid, in-depth investigation of each flagged transaction, cross-referencing with other data sources and customer profiles, and only escalating for further action or customer contact after initial human validation. Option B. Implement a temporary, broader set of transaction restrictions across all customer segments until the system's alert parameters can be recalibrated, accepting a higher rate of false positives to ensure no fraudulent activity proceeds unchecked. Option C. Share the raw alert data with a third-party fraud analytics firm for immediate analysis and recommendations, without first anonymizing or aggregating the data, to expedite the identification of genuine threats. Option D. Immediately suspend all flagged transactions and initiate a full review of all customer accounts exhibiting suspicious activity, prioritizing the cessation of potential fraud over any immediate customer inconvenience. The correct answer is D. Immediately suspend all flagged transactions and initiate a full review of all customer accounts exhibiting suspicious activity, prioritizing the cessation of potential fraud over any immediate customer inconvenience. Explanation: this scenario is professionally challenging because it requires balancing the imperative to detect and prevent fraud with the need to maintain customer trust and adhere to regulatory obligations concerning data privacy and fair treatment. A senior executive must make a critical decision that impacts operational efficiency, regulatory compliance, and the company's reputation. The chosen approach must be robust enough to identify suspicious activities while minimizing the risk of false positives and unwarranted customer scrutiny. The correct approach involves implementing a multi-layered fraud detection system that combines advanced analytics with human oversight, ensuring that any flagged activity is thoroughly investigated before action is taken. This aligns with regulatory expectations for robust anti-fraud measures, such as those outlined in the UK's Financial Services and Markets Act 2000 FSMA, and the Financial Conduct Authority's FCA principles for businesses, particularly Principle 1, integrity, and Principle 2, skill, care, and diligence. It also respects data protection principles under the UK GDPR, ensuring that data is processed lawfully, fairly, and transparently, and that individuals are not subjected to decisions based solely on automated processing that produces legal or similarly significant effects without appropriate safeguards. An approach that relies solely on automated flagging without human review is incorrect because it risks unfairly penalizing legitimate customers and may not capture sophisticated fraud schemes that bypass simple algorithmic detection. This could lead to breaches of regulatory requirements related to treating customers fairly, and could also violate data protection principles by making significant decisions about individuals without human intervention. An approach that prioritizes speed of detection over accuracy and customer impact is incorrect. While rapid detection is desirable, it must not come at the expense of thorough investigation. This could lead to regulatory sanctions for failing to act with due skill, care, and diligence, and could also damage the firm's reputation and customer relationships. An approach that involves sharing customer data with third parties without explicit consent or a clear legal basis even for fraud prevention purposes, is incorrect. This would likely contravene the UK GDPR and the FCA's requirements for data handling and customer confidentiality, potentially leading to significant fines and reputational damage. The professional decision-making process should involve a risk-based assessment, considering the potential impact of fraud versus the impact of detection measures on customers. It should also involve consulting with legal and compliance teams to ensure adherence to all relevant regulations. A framework that emphasizes a proportionate response, continuous review of detection methods, and clear escalation procedures for flagged cases, coupled with robust data governance, is essential for effective and compliant fraud management. Question 10. Compliance review shows that the company is considering upgrading its claims management system. The executive team is debating between three potential systems. One system offers the lowest upfront cost and a user-friendly interface for claims adjusters. Another system is known for its advanced automation capabilities, promising significant efficiency gains, but its reporting features are generic and may require substantial customization to meet regulatory standards. The third system, while more expensive, is specifically designed to align with the regulatory framework of this jurisdiction, offering comprehensive audit trails, robust data security, and pre-built regulatory reporting modules. Which approach to selecting the new claims management system is most aligned with regulatory compliance and professional responsibility? Option A. Choose the system specifically designed to align with the regulatory framework of this jurisdiction, despite its higher initial cost. Option B. Prioritize the system with advanced automation, as efficiency gains will indirectly support better claims handling and compliance. Option C. Opt for a system that offers a balance between cost and basic functionality, with the understanding that compliance can be managed through manual processes and supplementary software. Option D. Select the system with the lowest upfront cost and user-friendly interface, assuming that customization can be done later if regulatory gaps are identified. Correct answer is D. Select the system with the lowest upfront cost and user-friendly interface, assuming that customization can be done later if regulatory gaps are identified. Explanation. This scenario presents a professional challenge because it requires balancing operational efficiency with the stringent regulatory requirements governing claims management systems. The executive must ensure that the chosen system not only meets the business's immediate needs, but also complies with all applicable laws and guidelines, particularly concerning data integrity, customer protection, and reporting obligations. Failure to do so can lead to significant financial penalties, reputational damage, and loss of customer trust. Careful judgment is required to assess the long-term implications of system selection, beyond immediate cost or functionality. The correct approach involves a comprehensive evaluation of potential claims management systems against the specific regulatory framework of the jurisdiction. This includes verifying that the system supports accurate and timely claims processing, maintains robust audit trails, ensures data security and privacy in line with regulatory mandates, and facilitates the generation of required regulatory reports. Adherence to these principles is paramount for demonstrating compliance and upholding ethical standards in claims handling. An approach that prioritizes only cost reduction without a thorough regulatory compliance check is professionally unacceptable. This failure stems from a disregard for legal obligations, potentially exposing the organization to fines and sanctions for non-compliance with data protection, claims handling, or reporting regulations. Similarly, an approach that focuses solely on the perceived ease of use for claims handlers, neglecting the system's ability to meet regulatory reporting requirements or maintain data integrity, is also flawed. This oversight can lead to inaccurate reporting, which is a direct violation of regulatory mandates and can result in penalties. Furthermore, a system that does not adequately protect sensitive customer data or provide clear audit trails can breach data privacy laws and undermine the principles of fair claims handling. The professional decision-making process for similar situations should involve a multifaceted assessment. First, clearly identify all relevant regulatory requirements pertaining to claims management systems within the specified jurisdiction. Second, establish a robust evaluation framework that assesses potential systems against these regulatory mandates, alongside operational needs and cost-effectiveness. Third, Involve legal and compliance teams in the review process to ensure all regulatory nuances are addressed. Finally, prioritize systems that demonstrate a clear commitment to regulatory adherence and ethical claims handling, even if they represent a higher initial investment, as this mitigates long-term risks and ensures sustainable compliance. Question 11. Strategic planning requires a health insurance executive to consider expanding into a new, previously untapped international market. The executive is presented with two potential product strategies, one that leverages existing, successful product designs from their home market with minimal adaptation, and another that involves extensive research into the new market's specific health needs, regulatory requirements, and competitive landscape to develop bespoke products. Which approach best aligns with best practice for responsible market entry and regulatory compliance? Option A. Adapting existing product designs from the home market with minimal changes to expedite market entry and reduce initial development costs. Option B. Delegating the entire product adaptation and regulatory approval process to a newly hired local sales team with minimal senior management oversight. Option C. Relying on the assumption that regulatory frameworks in most developed markets are similar enough to allow for broad product applicability. Option D. Developing bespoke products after extensive research into the new market's specific health needs, regulatory requirements, and competitive landscape. The correct answer is D. Developing bespoke products after extensive research into the new market's specific health needs, regulatory requirements, and competitive landscape. Explanation. This scenario presents a professional challenge because it requires an executive to balance the strategic imperative of market expansion with the fundamental regulatory obligation to ensure product suitability and consumer protection within the health insurance sector. The executive must navigate the complexities of a new market, understanding its unique demographic needs, existing healthcare infrastructure, and the specific regulatory landscape governing health insurance products. Failure to conduct thorough due diligence risks launching products that are either non-compliant, inadequate for the target population, or exploitative, leading to significant reputational damage, regulatory sanctions, and financial penalties. Careful judgment is required to ensure that commercial objectives do not override ethical and legal responsibilities. The correct approach involves a comprehensive market analysis and product development process that prioritizes regulatory compliance and consumer needs. This entails understanding the specific health insurance regulations in the target jurisdiction, including requirements for policy terms, benefits, pricing, disclosure, and claims handling. It also requires assessing the health needs and affordability of the target population to design products that are both relevant and accessible. This approach ensures that the company acts responsibly and ethically, building trust with consumers and regulators, and establishing a sustainable market presence. An incorrect approach would be to prioritize speed to market by adapting existing, potentially unsuitable products without rigorous local adaptation and regulatory review. This fails to acknowledge the specific legal and ethical obligations within the new jurisdiction. It risks offering products that do not meet local consumer needs or comply with local regulations, leading to potential mis-selling, consumer detriment, and regulatory breaches. Another incorrect approach is to assume that what is permissible or standard in the company's home market will automatically be acceptable in the new jurisdiction. This demonstrates a lack of due diligence and a disregard for the principle of regulatory adherence in each operating territory. It can lead to unintentional non-compliance and expose the company to significant legal and financial repercussions. Finally, an incorrect approach would be to delegate the entire product development and regulatory compliance process to a local marketing team without adequate oversight from senior management and legal/compliance departments. While local expertise is valuable, ultimate executive responsibility for ensuring regulatory compliance and ethical product offerings rests with leadership. This abdication of responsibility can result in systemic failures and a lack of strategic alignment with regulatory requirements. The professional decision-making process for similar situations should involve a structured approach. First, clearly identify the regulatory framework of the target jurisdiction. Second, conduct thorough market research to understand consumer needs and existing healthcare landscape. Third, engage legal and compliance experts early in the product development lifecycle. Fourth, develop products that are demonstrably compliant and suitable for the target market. Fifth, Implement robust internal controls and oversight mechanisms to ensure ongoing adherence to regulations and ethical standards. Finally, foster a culture of compliance and ethical conduct throughout the organization. Question 12. The efficiency study reveals that while medical coverage has high utilization, dental and vision coverage exhibit lower claim frequencies. As an executive responsible for product strategy, how should you approach potential adjustments to these coverage types to optimize resource allocation while adhering to regulatory requirements and maintaining policyholder satisfaction? Option A. Eliminate dental and vision coverage entirely from new policy offerings, citing the study's findings on lower utilization as justification for discontinuing these less profitable lines. Option B. Immediately reduce the scope and benefit levels of dental and vision coverage to align with their observed lower claim frequencies, focusing on cost savings to improve overall profitability. Option C. Introduce bundled packages that combine medical coverage with significantly scaled-back dental and vision benefits, marketing them as comprehensive solutions without detailing the reduced scope of the ancillary coverages. Option D. Conduct a detailed analysis of the specific dental and vision benefits offered, their perceived value by policyholders, and the regulatory requirements for minimum coverage standards in the relevant jurisdiction before proposing targeted enhancements or modifications that align with market needs and financial sustainability. The correct answer is D. Conduct a detailed analysis of the specific dental and vision benefits offered, their perceived value by policyholders, and the regulatory requirements for minimum coverage standards in the relevant jurisdiction, before proposing targeted enhancements or modifications that align with market needs and financial sustainability. Explanation: this scenario is professionally challenging because it requires an executive to balance the financial implications of coverage offerings with the ethical and regulatory obligations to provide adequate and appropriate benefits to policyholders. The executive must understand the nuances of different coverage types and how they align with market demands and regulatory expectations without compromising the insurer's solvency or misleading customers. Careful judgment is required to ensure that the proposed changes are not only cost-effective, but also compliant with insurance laws and ethical standards, particularly concerning consumer protection and fair treatment. The correct approach involves a comprehensive review of the existing coverage portfolio, considering market trends, competitor offerings, and the specific needs of the target demographic, while rigorously assessing the regulatory landscape for each coverage type. This approach prioritizes a data-driven understanding of customer demand and the financial viability of each benefit, ensuring that any proposed adjustments to medical, dental, and vision coverage are well justified, transparent, and compliant with all applicable insurance regulations. This aligns with the duty of care owed to policyholders and the regulatory imperative to maintain fair and transparent insurance practices. An incorrect approach would be to unilaterally reduce or eliminate coverage based solely on perceived low utilization, without a thorough analysis of the potential impact on policyholder health outcomes or the insurer's reputation. This could lead to accusations of unfair claims handling or a failure to meet contractual obligations. Another incorrect approach would be to introduce new, less comprehensive coverage options without clearly communicating the limitations and potential gaps in protection to consumers, which would violate principles of transparency and potentially lead to regulatory scrutiny for misrepresentation. Focusing solely on cost reduction without considering the value proposition to the insured or the competitive market position would also be a flawed strategy, potentially alienating customers and impacting market share. Professionals should employ a decision-making framework that begins with a clear understanding of the regulatory environment governing each type of insurance coverage. This should be followed by a thorough market analysis to gauge demand and competitive offerings. Crucially, a robust assessment of the financial implications and potential risks associated with any proposed changes must be conducted. Transparency with stakeholders, including policyholders and regulators, throughout the decision-making process is paramount. Ethical considerations, such as the impact on vulnerable populations and the insurer's commitment to providing meaningful coverage, should be integrated into the evaluation. Question 13. The evaluation methodology shows an insurance executive tasked with improving the company's financial performance. The executive is considering several strategies to reduce operational costs and enhance profitability, Which of the following approaches best aligns with the principles of sound insurance practice and regulatory compliance, ensuring the long-term security of policyholders? Option A. Substantially increasing premiums for all policyholders to rapidly boost revenue, irrespective of market conditions or the value proposition offered. Option B. Reducing investment in risk management and compliance departments to reallocate funds to short-term profit-generating activities. Option C. Implementing a targeted review of operational processes to identify and eliminate inefficiencies, focusing on non-core functions and leveraging technology to streamline administrative tasks, while ensuring no compromise to underwriting, claims, or customer service quality. Option D. Initiating significant staff layoffs across all departments to achieve immediate cost savings, without a detailed analysis of the impact on critical insurance functions. Correct answer is C. Implementing a targeted review of operational processes to identify and eliminate inefficiencies, focusing on non-core functions and leveraging technology to streamline administrative tasks, while ensuring no compromise to underwriting, claims, or customer service quality. Explanation. The evaluation methodology shows a scenario where an executive must balance the immediate financial pressures of a company with the long-term solvency and fair treatment of policyholders. This is professionally challenging because the executive's decisions can have significant repercussions on the company's financial health, its ability to meet future claims, and its reputation within the market. The core tension lies in adhering to regulatory solvency requirements, while also managing operational costs and profitability. Careful judgment is required to ensure that any cost-saving measures do not compromise the fundamental principles of insurance, such as utmost good faith and the insurer's ability to pay claims. The correct approach involves a comprehensive review of all operational expenses, identifying areas for efficiency gains without impacting core underwriting, claims handling, or customer service functions that directly affect policyholder protection. This approach prioritizes regulatory compliance with solvency margins and capital adequacy requirements, ensuring the insurer remains financially sound. It also aligns with the ethical duty to policyholders to maintain a robust and solvent insurer capable of fulfilling its contractual obligations. This is justified by the regulatory framework, which mandates specific capital reserves and solvency standards to protect policyholders. For example, under the relevant regulatory framework, assuming UK/SISI for this exam, the Prudential Regulation Authority, PRA, sets stringent capital requirements and expects firms to operate prudently, with a focus on long-term viability and policyholder protection. An incorrect approach would be to implement across-the-board staff redundancies without a strategic assessment of their impact on critical functions. This is a regulatory failure because it could lead to a deterioration in claims handling efficiency, underwriting quality, or customer support, potentially breaching service-level agreements and impacting the insurer's ability to manage risk effectively. Ethically, it demonstrates a disregard for the impact on employees and could signal a short-sighted approach to financial management that ultimately jeopardizes policyholder security. Another incorrect approach would be to significantly increase premiums across all policy types to boost immediate revenue, without a corresponding increase in the value or service provided to policyholders. This is an ethical failure as it could be seen as exploiting policyholders to address internal financial issues, potentially breaching the principle of fairness and transparency. It could also be a regulatory issue if it leads to market distortion or anti-competitive practices, depending on the specific market regulations. A third incorrect approach would be to reduce investment in risk management and compliance functions to cut costs. This is a severe regulatory and ethical failure. Regulators mandate robust risk management and compliance frameworks to prevent financial distress and ensure adherence to laws and ethical standards. Undermining these functions directly exposes the insurer to increased risk of solvency issues, fraud, and regulatory sanctions, fundamentally betraying the trust placed in the executive and the company by policyholders and regulators. A professional decision-making process for similar situations should involve a structured risk-based assessment. This includes understanding the specific regulatory requirements for solvency and capital adequacy, evaluating the potential impact of any proposed action on policyholder interests, and considering the ethical implications for all stakeholders. Engaging with relevant internal departments, e.g., Actuarial risk, compliance, and seeking external expert advice when necessary are crucial steps. The executive must always prioritize the long-term financial stability and integrity of the insurer, ensuring it can meet its obligations to policyholders, in line with regulatory expectations and ethical principles. Question 14. Compliance review shows that a new commercial property insurance product is being developed for businesses located in areas prone to significant seismic activity. Which approach to defining coverage types for this product best aligns with regulatory expectations for responsible underwriting and consumer protection? Option A. Rely exclusively on historical claims data from other regions to determine the scope of earthquake coverage, without specific analysis of the target region's seismic profile. Option B. Conduct a detailed risk assessment to identify the specific seismic risks and their potential financial impact. Then design core coverage to address these identified risks comprehensively, supplemented by appropriate deductibles and policy limits. Option C. Include broad coverage for all conceivable natural disasters, regardless of their likelihood or specific relevance to the insured's location, to maximize perceived customer value. Option D. Prioritize coverage for common perils like fire and theft, with natural disaster coverage, including earthquakes, offered only as an optional add-on with a high deductible. The correct answer is D. Prioritize coverage for common perils like fire and theft, with natural disaster coverage, including earthquakes, offered only as an optional add-on with a high deductible. Explanation. This scenario is professionally challenging because it requires an executive to balance the insurer's financial prudence with the ethical obligation to provide adequate coverage that accurately reflects the risks faced by policyholders. Misjudging coverage types can lead to underinsurance, leaving clients exposed to significant financial loss, or overinsurance, which can be financially unsustainable for the insurer and potentially lead to market distortions. The executive must demonstrate a deep understanding of the regulatory expectations for risk assessment in product development and underwriting, ensuring that coverage aligns with identified perils and their potential impact. The correct approach involves a comprehensive risk assessment that meticulously identifies potential perils relevant to the insured's operations and location, and then matches these perils with appropriate coverage types. This ensures that the policy provides meaningful protection against foreseeable events. For instance, a business operating in a coastal region would necessitate a thorough assessment of natural disaster risks, including flood and storm surge, and the corresponding coverage options. This aligns with regulatory principles that mandate insurers to underwrite risks responsibly and to offer products that are suitable for the needs of the market, preventing adverse selection and ensuring solvency. The Insurance Executive Certificate Framework emphasizes a proactive and informed approach to risk management, which directly translates to accurate coverage selection. An incorrect approach that focuses solely on minimizing the insurer's immediate claims payout potential would be ethically and regulatorily unsound. This approach fails to acknowledge the fundamental purpose of insurance, which is to provide financial protection against specified losses. Such a narrow focus could lead to the exclusion of critical coverage types that are essential for protecting policyholders from significant financial harm, thereby violating the principle of utmost good faith and potentially breaching regulatory requirements for fair treatment of customers. Another incorrect approach that prioritizes offering the broadest possible coverage without a corresponding risk assessment is also problematic. While seemingly customer-centric, this can lead to offering coverage for highly improbable or uninsurable risks, inflating premiums unnecessarily, and potentially creating a portfolio of unmanageable liabilities for the insurer. This demonstrates a lack of due diligence in risk assessment and underwriting, which is a core expectation for insurance executives and can lead to regulatory scrutiny regarding solvency and product suitability. Finally, an approach that relies on historical claims data alone without considering emerging risks or changes in the operating environment is insufficient. While historical data is valuable, it may not capture the full spectrum of current or future risks, such as those arising from climate change or new technological advancements. A responsible executive must integrate forward-looking risk assessment methodologies to ensure coverage remains relevant and adequate. The professional decision-making process for similar situations should involve a structured risk assessment framework. This framework should begin with identifying the insured's specific context, including their industry, geographic location, and operational activities. Subsequently, a thorough analysis of potential perils should be conducted, drawing on both historical data and expert insights into emerging risks. The next step is to evaluate the potential financial impact of these perils. Finally, coverage types should be selected and designed to provide appropriate protection against the identified and assessed risks, ensuring compliance with all relevant regulations and ethical standards. Question 15. Quality control measures reveal a pattern of minor, but consistent, misrepresentations in renewal applications submitted by a long-standing and high-value corporate client. The underwriting team has flagged these discrepancies, which, while not immediately impacting the current policy's risk profile, suggest a lack of diligence or intentional omission by the client's broker. The executive is aware that confronting the client directly about these issues could jeopardize the lucrative account. Option A. Instruct the underwriting team to overlook the discrepancies for this particular client, given their significant business value, and to proceed with the renewal as is. Option B. Immediately inform the client that their renewal will be significantly delayed due to their broker's repeated errors, demanding a substantial premium increase as a penalty. Option C. Advise the underwriting team to simply ask the client's broker for a verbal assurance that the information will be more accurate in the future, without further investigation or documentation. Option D. Initiate a formal, objective investigation into the renewal application discrepancies, documenting all findings and communicating the necessary corrective actions to the client and their broker, while also reviewing internal processes to prevent future occurrences. The correct answer is D. Initiate a formal, objective investigation into the renewal application discrepancies, documenting all findings and communicating the necessary corrective actions to the client and their broker, while also reviewing internal processes to prevent future occurrences. Explanation. This scenario presents a professional challenge due to the inherent conflict between a desire to retain a valuable client and the obligation to uphold ethical standards and regulatory compliance. The executive must navigate the pressure to overlook a minor infraction that could have broader implications if not addressed appropriately. Careful judgment is required to balance business relationships with professional integrity and legal responsibilities. The correct approach involves a thorough, objective investigation and a transparent communication process. This upholds the principle of fairness and ensures that all parties are treated equitably, in line with the insurance executive certificate's emphasis on integrity and compliance. Specifically, it aligns with the regulatory expectation that all business dealings are conducted with honesty and due diligence, and that any potential breaches of policy or regulation are investigated and rectified. This approach prioritizes the long-term health of the business by maintaining its reputation for ethical conduct and adherence to the law, rather than risking reputational damage and potential regulatory sanctions by ignoring the issue. An incorrect approach of immediately dismissing the concern to appease the client fails to acknowledge the potential systemic risks or the regulatory duty to investigate. This could lead to a breach of regulatory requirements concerning fair treatment of customers and accurate record keeping. Another incorrect approach of exaggerating the issue to justify a punitive action against the client, while seemingly addressing the problem, is unethical as it lacks proportionality and objectivity. This would violate principles of fairness and could lead to a damaged client relationship and potential complaints. A third incorrect approach of delaying the investigation indefinitely to avoid confronting the client undermines the principle of timely resolution and can be seen as a failure to act with due diligence, potentially exposing the firm to regulatory scrutiny for inaction. Professionals should employ a decision-making framework that begins with identifying the ethical and regulatory implications of the situation. This involves consulting relevant codes of conduct, company policies, and applicable regulations. The next step is to gather all relevant facts objectively, without bias. Then, evaluate the potential consequences of different courses of action, considering the impact on the client, the company, and regulatory standing. Finally, choose the course of action that best upholds ethical principles and regulatory requirements, ensuring transparency and fairness throughout the process. Question 16. The audit findings indicate that the marketing department has been rapidly developing new promotional materials for a range of life insurance products, with a focus on highlighting potential investment growth. Several of these materials have been disseminated to intermediaries and directly to consumers without a formal review by the compliance or legal departments. The marketing team argues that this approach allows them to be agile and responsive to market trends, ensuring they are always presenting the most attractive product features. The head of marketing proposes continuing this practice, suggesting that the sales team is adequately trained to clarify any complex details. Which of the following approaches best addresses the audit findings and ensures compliance with regulatory marketing principles? A. Implement a mandatory pre-approval process for all marketing materials by the compliance department before dissemination, ensuring accuracy and adherence to regulatory standards. B. Continue the current practice, but enhance the training for the sales team to ensure they can effectively explain any nuances or potential misinterpretations of the marketing materials. C. Focus marketing efforts on highlighting only the most positive and aspirational aspects of the products, trusting that consumers will seek further clarification if needed. D. Expedite the development of marketing materials by relying on templates and pre-approved phrases, with a post-dissemination review conducted by compliance on a sample basis. Option A. Expedite the development of marketing materials by relying on templates and pre-approved phrases, with a post-dissemination review conducted by compliance on a sample basis. Option B. Continue the current practice but enhance the training for the sales team to ensure they can effectively explain any nuances or potential misinterpretations of the marketing materials. Option C. Focus marketing efforts on highlighting only the most positive and aspirational aspects of the products, trusting that consumers will seek further clarification if needed. Option D. Implement a mandatory pre-approval process for all marketing materials by the compliance department before dissemination, ensuring accuracy and adherence to regulatory standards. The correct answer is D. Implement a mandatory pre-approval process for all marketing materials by the compliance department before dissemination, ensuring accuracy and adherence to regulatory standards. Explanation: this scenario is professionally challenging because it requires balancing aggressive marketing strategies with the imperative to provide accurate and non-misleading information to potential policyholders, a core principle in insurance regulation. The executive must exercise careful judgment to ensure that promotional materials comply with all relevant laws and ethical standards, particularly concerning product features and benefits. The correct approach involves a thorough review of all marketing materials by the compliance department to ensure they accurately reflect policy terms and conditions, avoiding any exaggeration or omission of material facts. This aligns with the regulatory framework's emphasis on consumer protection and fair dealing. Specifically, under the Insurance Conduct of Business Rules (ICOBs) in the UK, firms have a duty to act honestly, fairly, and professionally in accordance with the best interests of their clients. This includes ensuring that all communications, including financial promotions, are clear, fair, and not misleading. The approach of seeking explicit compliance sign-off before dissemination directly addresses this duty by embedding a control mechanism to prevent regulatory breaches. An incorrect approach that relies solely on the sales team's understanding of the product is professionally unacceptable. This fails to acknowledge the regulatory requirement for independent oversight of marketing content. Sales teams, while knowledgeable about product benefits, may inadvertently or intentionally present information in a way that is overly optimistic or omits crucial details, leading to potential misrepresentation and breaches of ICOBs, which mandates that firms must not mislead consumers. Another incorrect approach that prioritizes speed to market over accuracy is also professionally unsound. This approach disregards the fundamental regulatory principle that consumer interests must be protected. Rushing marketing materials without proper scrutiny increases the risk of errors, omissions, or misleading statements, which can result in significant regulatory penalties, reputational damage, and harm to consumers. The Financial Conduct Authority, FCA, expects firms to have robust systems and controls in place to ensure compliance with its rules. An move fast and break things mentality is incompatible with this expectation. The professional reasoning process for similar situations should involve a structured risk assessment of marketing activities. This includes identifying potential areas of misrepresentation, understanding the target audience's susceptibility to misleading information, and establishing clear internal procedures for content creation, review, and approval. Professionals should always prioritize regulatory compliance and consumer welfare, understanding that short-term gains from aggressive marketing are outweighed by the long-term consequences of regulatory breaches and loss of trust. A culture of compliance, where all employees understand their role in upholding regulatory standards, is essential. Question 17. What factors determine the most effective and compliant approach for an insurance executive to enhance customer service while managing operational costs? Option A. Focusing investment primarily on sales and marketing initiatives, with minimal allocation to customer support infrastructure. Option B. Implementing cost-saving measures that may limit accessibility or support for vulnerable customer segments. Option C. Prioritizing immediate cost reductions in customer service departments through staff reductions and automation, regardless of service impact. Option D. A comprehensive analysis of customer feedback, complaint trends, and regulatory requirements to identify and address systemic service issues. The correct answer is D. A comprehensive analysis of customer feedback, complaint trends, and regulatory requirements to identify and address systemic service issues. Explanation. This scenario is professionally challenging because an executive must balance the company's financial interests with the ethical and regulatory obligations to provide fair and transparent customer service, particularly when dealing with vulnerable customers. The pressure to reduce costs must not compromise the quality or accessibility of service, which can have significant reputational and legal consequences. Careful judgment is required to ensure that cost-saving measures do not inadvertently lead to a breach of regulatory requirements or ethical standards. The correct approach involves a comprehensive review of customer feedback, complaint data, and regulatory guidance to identify systemic issues impacting customer service. This proactive and data-driven strategy allows for targeted improvements that address root causes, enhance customer satisfaction, and ensure compliance with regulations such as those governing fair treatment of customers and complaint handling. This aligns with the principles of good governance and customer centricity expected of insurance executives, promoting long-term trust and business sustainability. An approach focused solely on reducing operational costs without considering the impact on customer service quality would be a significant regulatory and ethical failure. This could lead to breaches of regulations requiring firms to act honestly, fairly, and professionally in accordance with the best interests of their customers. For instance, reducing staffing levels to a point where response times become unacceptably long, or where complex queries cannot be adequately addressed, could be seen as failing to treat customers fairly. Another incorrect approach would be to implement cost-saving measures that disproportionately affect vulnerable customers, such as removing accessible communication channels or simplifying processes to the detriment of those who require more support. This would likely violate principles of treating customers fairly and could lead to regulatory sanctions for failing to consider the specific needs of different customer segments. A third incorrect approach would be to prioritize marketing and sales over customer support infrastructure. While sales are crucial, neglecting the post-sale service aspect can lead to a surge in complaints and dissatisfaction, ultimately harming the company's reputation and potentially leading to regulatory scrutiny for failing to manage customer relationships effectively. The professional decision-making process for similar situations should involve a multifaceted assessment. Executives must first understand the regulatory landscape and their firm's specific obligations regarding customer service. They should then gather and analyze data on customer interactions, complaints, and satisfaction levels. This data should be used to identify areas for improvement, considering both operational efficiency and customer experience. Any proposed changes, especially those aimed at cost reduction, must be rigorously assessed for their potential impact on customer service quality and regulatory compliance. Engaging with customer focus groups or seeking expert advice can also inform these decisions. Ultimately, the decision should prioritize the long-term health of the business, which is inextricably linked to customer trust and regulatory adherence. Question 18. Examination of the data shows that a first notice of loss FNOL has been received for property damage claim. The policyholder has provided a brief description of the incident, stating water damage from burst pipe in kitchen. However, the FNOL form is missing details regarding the exact date and time of the burst, the estimated cost of repairs, and whether the policyholder has taken any immediate mitigation steps. The claims handler is considering assigning the claim directly to a loss adjuster for an immediate site visit and repair assessment, Which of the following represents the most appropriate initial action for the claims handler to take? A. Immediately assign the claim to a loss adjuster for an on-site assessment and repair estimation, as the core incident is clear. B. Contact the policyholder to obtain the missing details regarding the date and time of the incident, any mitigation efforts undertaken, and a preliminary estimate of repair costs before assigning the claim. C. Place the claim on hold until the policyholder provides a detailed report from a qualified plumber confirming the cause and extent of the damage. D. Assign the claim to a junior claims assessor for an initial review and to gather further information from the policyholder via email. Option A. Place the claim on hold until the policyholder provides a detailed report from a qualified plumber confirming the cause and extent of the damage. Option B. Immediately assign the claim to a loss adjuster for an on-site assessment and repair estimation, as the core incident is clear. Option C. Assign the claim to a junior claims assessor for an initial review and to gather further information from the policyholder via email. Option D. Contact the policyholder to obtain the missing details regarding the date and time of the incident, any mitigation efforts undertaken, and a preliminary estimate of repair costs before assigning the claim. The correct answer is D. Contact the policyholder to obtain the missing details regarding the date and time of the incident, any mitigation efforts undertaken, and a preliminary estimate of repair costs before assigning the claim. Explanation. This scenario presents a professional challenge due to the critical nature of the first notice of loss, FNOL, process in insurance. FNOL is the initial point of contact for a claim and sets the tone for the entire claims handling process. Errors or omissions at this stage can lead to significant financial, reputational, and regulatory consequences. The executive must balance efficiency with accuracy and compliance, ensuring that all necessary information is captured promptly and correctly, while also managing customer expectations and adhering to regulatory requirements. The challenge lies in interpreting incomplete or potentially misleading initial information and making sound decisions that uphold the insurer's obligations. The correct approach involves a thorough and systematic review of all available FNOL data, cross-referencing it with policy terms and conditions, and identifying any immediate gaps or inconsistencies that require further investigation. This approach prioritizes accuracy and compliance by ensuring that the insurer has a clear understanding of the reported loss before proceeding with claim assessment. It aligns with regulatory expectations for diligent claims handling, which mandate that insurers act in good faith and with reasonable care. Specifically, under the Insurance Conduct of Business Sourcebook, ICOBS, in the UK, firms have obligations to treat customers fairly and to handle claims promptly and fairly. A comprehensive review ensures that the initial assessment is robust and avoids premature decisions that could disadvantage the policyholder or expose the insurer to undue risk. An incorrect approach that focuses solely on speed and immediate claim assignment without verifying the initial information would be professionally unacceptable. This failure would contravene ICOB's requirements for fair treatment of customers, as it risks misclassifying the claim or overlooking crucial details that could impact coverage or the settlement amount. It also exposes the insurer to potential regulatory scrutiny for inadequate claims handling procedures. Another incorrect approach, which involves delaying the claim process due to minor ambiguities in the FNOL, would also be professionally unsound. While thoroughness is important, excessive delay without clear justification can be seen as unfair treatment of the policyholder and may breach ICOB's principles regarding promptness in claims handling. This can lead to customer dissatisfaction and potential complaints to the Financial Ombudsman Service. A third incorrect approach, which is to accept the FNOL information at face value without any internal verification or cross-referencing with policy details, is also problematic. This demonstrates a lack of due diligence and could lead to incorrect coverage decisions, potentially resulting in underpayment or denial of valid claims or overpayment of invalid ones. This directly conflicts with the regulatory expectation of acting with reasonable care and skill. The professional decision-making process for similar situations should involve a structured approach. First, gather all available FNOL data. Second, immediately cross-reference this data with the relevant policy documentation. Third, identify any discrepancies, missing information, or potential red flags. Fourth, determine the appropriate next steps based on the identified issues, which may include requesting further information from the policyholder, initiating an investigation, or assigning the claim to a specialist handler. And fifth, ensure all actions are documented and comply with regulatory requirements and internal procedures. Question 19. When evaluating a new insurance product designed to cover valuable art collections, which is presented as offering a fixed payout amount in the event of total loss, what is the most appropriate approach for an executive to determine its classification and ensure regulatory compliance? Option A. Classify the product by its marketing name, assuming it accurately reflects the coverage type, and proceed with standard disclosure practices for that named category. Option B. Classify the product based on its primary function of protecting against loss, without delving into the specific mechanics of how the payout is determined, as the market generally understands such policies. Option C. Classify the product as agreed value coverage after confirming the payout amount is clearly stated in the policy, as this aligns with the product's presentation of a fixed payout. Option D. Classify the product by comparing its features to other similar products in the market, assuming that common industry practice dictates the correct classification. The correct answer is C. Classify the product as agreed value coverage after confirming the payout amount is clearly stated in the policy, as this aligns with the product's presentation of a fixed payout. Explanation. This scenario presents a professional challenge due to the inherent ambiguity in classifying complex insurance products and the potential for misrepresentation or inadequate disclosure to clients. The executive must navigate the nuances of coverage types to ensure compliance with regulatory requirements and uphold ethical obligations to policyholders. Careful judgment is required to accurately categorize the product, which directly impacts its regulatory treatment, marketing, and the information provided to potential buyers. The correct approach involves a thorough analysis of the product's features and benefits against the established definitions of different coverage types within the relevant regulatory framework. This ensures that the product is correctly classified, leading to appropriate policy terms, premium calculations, and disclosure documents. Specifically, understanding the distinction between indemnity and agreed value coverage is crucial. Indemnity coverage aims to restore the insured to their pre-loss financial position, while agreed value coverage fixes the payout amount at the inception of the policy. Misclassifying a product can lead to regulatory sanction, consumer complaints, and reputational damage. An incorrect approach of classifying the product based solely on its most prominent feature, without considering its underlying principles of compensation, would be a significant regulatory and ethical failure. This could lead to the product being marketed under a misleading description, potentially causing policyholders to believe they have coverage that does not align with the actual terms and conditions. For instance, if a product offers a fixed payout but is marketed as a pure indemnity policy, it misrepresents the nature of the coverage and the basis of settlement. Another incorrect approach of relying on industry jargon or common market terminology without verifying against the precise regulatory definitions would also be professionally unacceptable. Regulatory frameworks often have specific, legally defined terms for coverage types, and deviating from these can lead to non-compliance. Furthermore, assuming that a product's name dictates its coverage type without a detailed review of the policy wording and underlying mechanics is a risky and potentially unethical practice. Professional decision-making process for similar situations should involve a systematic review of the product's policy documents, including the wording, endorsements, and any related marketing materials. This should be cross-referenced with the specific definitions and requirements outlined in the applicable insurance regulations. When in doubt, seeking clarification from legal counsel or regulatory bodies is a prudent step. The ultimate goal is to ensure transparency, fairness, and compliance in all product offerings and client interactions. Question 20. Stakeholder feedback indicates a growing concern regarding the perceived lack of profitability in certain product lines. As an executive, what is the most appropriate regulatory compliant approach to address this feedback concerning profitability ratios? Option A. Focus solely on increasing premiums for underperforming product lines to artificially inflate profitability metrics, without a comprehensive review of market competitiveness or policyholder value. Option B. Immediately implement aggressive cost reduction measures across all departments to boost profitability ratios, prioritizing short-term financial gains to appease stakeholders. Option C. Conduct a thorough analysis of the underlying drivers of profitability for each product line, considering underwriting results, investment income, and expense management, and assess the sustainability of these drivers in light of the current regulatory environment and solvency requirements. Option D. Reallocate capital from profitable product lines to cover the losses of underperforming ones, without a strategic plan for improving the latter's profitability or assessing the impact on the overall solvency of the entity. The correct answer is C. Conduct a thorough analysis of the underlying drivers of profitability for each product line, considering underwriting results, investment income, and expense management, and assess the sustainability of these drivers in light of the current regulatory environment and solvency requirements. Explanation: this scenario is professionally challenging because it requires an executive to balance the immediate pressure for improved financial performance with the long-term health and regulatory compliance of the insurance entity. Profitability ratios, while important indicators, can be manipulated or misinterpreted if not viewed within the broader context of solvency, customer fairness, and adherence to regulatory principles. The executive must exercise sound judgment to ensure that any strategic decisions aimed at enhancing profitability do not compromise the company's ability to meet its obligations or violate regulatory mandates. The correct approach involves a comprehensive review of profitability ratios in conjunction with other key performance indicators, particularly those related to solvency and policyholder protection. This includes understanding the underlying drivers of profitability, such as underwriting results, investment income, and expense management, and assessing their sustainability. Critically, this approach necessitates ensuring that any strategies to boost profitability align with the regulatory framework governing insurance operations, which prioritizes the financial soundness of the insurer and the fair treatment of policyholders. For instance, if a ratio indicates declining profitability, the executive must investigate whether this is due to market conditions, operational inefficiencies, or potentially aggressive pricing strategies that could jeopardize future solvency. Regulatory framework, such as that overseen by the Prudential Regulation Authority, PRA in the UK, mandates that insurers maintain adequate capital and reserves to meet their liabilities, and any actions taken must not undermine this fundamental requirement. An incorrect approach would be to focus solely on improving a specific profitability ratio, such as the expense ratio, by implementing drastic cost-cutting measures that compromise claims handling efficiency or customer service. This could lead to regulatory scrutiny for failing to uphold service standards or potentially impact the company's reputation and long-term viability, even if the immediate ratio improves. Another incorrect approach would be to interpret a high return on equity as solely a sign of success without investigating the risk profile associated with achieving that return. If the high return is driven by excessive investment risk, it could expose the insurer to significant losses, violating the regulatory expectation of prudent risk management. Furthermore, using profitability ratios to justify potentially unfair pricing practices that disadvantage certain customer segments would be a significant ethical and regulatory failure, as it contravenes principles of fairness and non-discrimination often embedded in insurance regulation. The professional decision-making process for similar situations should involve a multifaceted analysis. First, clearly define the objective. Is it short-term gain or sustainable long-term performance? Second, gather data not only on profitability ratios but also on solvency margins, claims reserves adequacy, customer satisfaction, and market conduct. Third, consult with relevant internal departments, actuarial, finance, risk, compliance, and potentially external advisors. Fourth, evaluate potential strategies against the established regulatory framework, considering the impact on policyholders, solvency, and market reputation. Finally, document the decision-making process and the rationale, ensuring transparency and accountability.